You're taking money out your limited company, presuming it to be a dividend throughout the year. Well, before you do, there's something really important you need to know. See, dividends can only be paid out of profits, and that's not just the money in your bank. We're talking real profit, after all your expenses, depreciation, interest payments, and corporation tax. Now here's the catch. You can't know if there's profit until after year-end accounts are done, which could be months after the money's been spent. It is at the year-end that dividends are declared and reported in the accounts. HMRC has a very clear view on dividends. If you're taking the same amount of money out of your business every month and calling it a dividend, to HMRC that starts to look like a salary. Now, a lot of business owners do this. They pay themselves a small salary, just enough to use their personal allowance of £12,570, and then top it up with a fixed monthly dividend. But here's the catch. Dividends are supposed to come from profits, and profits aren't guaranteed or predictable. So if you're taking the exact same amount each month, regardless of performance, HMRC could say, actually that's not a dividend, that's a salary. And if it's a salary, well then it's taxed as a salary. And that means employers' national insurance contributions are due. Now for small businesses and growing companies alike, one of the most reliable sources of funding is often the profits they generate. While it can be tempting to extract earnings in the form of dividends, there is a strong case for holding a portion of those profits to strengthen the business's financial position. Maintaining a strong cash position helps protect the business during lean periods, whether facing late customer payments, unexpected cost increases, or a sudden drop in demand. It's all about finding the balance, paying yourself while still reinvesting, putting a bit aside each year, gives you breathing room for growth. It keeps your cash flow strong and makes your business more resilient in the long run. Want to stay on top of it throughout the year and be able to withdraw regular dividends? That's where management accounts come in. These give you a live view of your finances so you can make confident, legal decisions about dividends. Produce them every month or 3 months, and you will be able to know with certainty what your profits available are, and then make informed decisions about how much you can afford to take as a dividend before year end. And don't forget, corporation tax still has to be paid. So this should be projected within the management accounts as it reduces what's actually left to take out. Before paying yourself a dividend, check the profits, run the numbers, and ideally, speak to your accountant first. It's better to be safe than sorry.